some point in time, we're going to see a physical run on the metals. We could see sub-20 oil, and it could happen very quickly. But I think when the markets really start to crash, I think you're going to see even larger increases in gold and silver.
Insider buying is surging, and legendary investors are piling into one specific gold deal, where the founders have already earned investors 500 and 900% gains on their two previous companies in the past 11 years. Now investors like founder of Pan American Silver, Ross Speedy, Rick Rule of Sprott Asset Management, and legendary fund manager and resource stock picker Marin Katusa are taking a stake in this new gold company. Insiders own 40% of the company. This is the gold play you don't want to miss out on. Learn more at crushthestreet.com/insider.
Hello, everyone, and welcome into crushthestreet.com. We got a returning guest today. He's a favorite on our show. His name is Steve St. Angelo of the SRSRoccoReport.com, and we're going to get a full update on metals and energy today from the man himself. Steve, thanks so much for joining me.
Yeah, Kenneth, it's always a pleasure. A lot of things happening. The pace is quickening, so there's a lot to talk about.
You know, the last time we talked, it would appear that precious metals were still in the bear market. And now, while we do this interview, it would appear that precious metals are in the uptrend. So I want to get your thoughts, initial thoughts on precious metals.
Yeah, last year, let's say during the outset of the retail shortage of silver, when there was a huge spike in demand due to problems with the Greek exit, in June, and then possible the Shemitah and the crash of the broader stock markets during the end of the year, a lot of investors were piling into silver, and then this made its way into gold, but most of the demand was really in silver. And I said this will get worse if we see a continued crash of the markets, the broader markets, and the prices of the metals would increase as the markets, the Dow Jones, S&P, as their indices would fall. Well, we started to see that, but then I think the Wizard of Oz at the Fed and central banks came in and they propped up the markets, and so it kind of held things over until after the new year. And then when the new year, we started seeing significant volatility again in the markets, and they were crashing. And I think last week, the Dow was really starting to fall apart, and it was cracking, and you could feel it, and you could actually see it when you turn on the financial networks. You could hear the folks on the commentators there, and they were nervous. And then that was the day that the gold and silver were up like 5%. So I do think we are now in a different trajectory now, and I think we're going to continue to see this, even though the markets are up today and the metals are up. But I think when the markets really start to crash, I think you're going to see even larger increases in gold and silver, and it's just amazing how investors, precious metal investors, are so, what's the word I'm looking for? We had a huge spike in the price, and I hear from dealers that day there was calling off the phone. I mean, the phones are ringing off the hook for people buying gold, and we're talking wealthy investors. And then, of course, as the markets were over the weekend, and then the metals were sold off in Asian trading when the markets were closed in the U.S., then it kind of slowed down. But it's amazing that investors should be buying precious metals hand over fist, but they're waiting until there's this extreme volatility. And we're just starting to get there right now. I think we're going to see a lot more buying in 2016. So,
Steve, what has been the turning point for precious metals, in your opinion? Why have we seen it? Was it the stock markets crashing? You've done a lot of research on the supply deficits that we're seeing in precious metals. Why do you see precious metals going in the opposite direction?
Well, I think it's several reasons, several factors. One, Janet Yellen talking about possible negative interest rates. And as we know, you look on Zero Hedge or many of the alternative news sites, that zero interest rates hasn't helped Japan, hasn't helped Europe. It's been a disaster. It's propped up the markets, but economically, it's a disaster. And so now that the U.S. Fed is considering that, and so I think investors back in 2015, they really didn't. I don't think they felt good about the markets, but they were still getting yield. Even though the stock prices weren't really falling a lot, but they weren't rising, but they were getting yield either in energy stocks or in the top Dow Jones stocks. But now we're starting to see the yield and dividends are being cut. And now this idea of negative interest rates or taking the interest rates back, going in reverse, and then the war on cash. I think the EU is thinking about getting rid of the 500 euro note, and now you hear Larry Summers is saying we should get rid of the $100 bill. So I think what's happening is there's a convergence, and the markets as well are starting to turn over. And I think they're going to turn over in a big way. And you put all this together, it's a perfect storm for owning the precious metals.
The perfect storm, yeah. So all I was going to say is there's just so many reasons why the precious metals thesis is bound to go higher. And you wrote in this article, you wrote a recent article here about the supply, demand, and the deficits that we're seeing right here in the U.S., and it is substantial. So go ahead. I didn't mean to cut you off. Please continue.
Yeah, I think since the price of gold and silver peaked in 2011, especially in the gold market in the U.S., we've seen a big change. There was some surpluses before, annual surpluses. That means there was more, there's mine supply, and then you add the imports and consumption and all that together, and there was a little bit of a surplus. However, since 2012, it's been a deficit, and it's actually been a large deficit. This year, 2015, well, let's say last year, I think total gold supply, and that includes mine supply from the United States, that includes the imports as well as scrap. It was like 553 metric tons. However, total demand, which is exports and consumption, was 671 metric tons. So there was a 118 metric ton shortfall that came from somewhere. And if you add up all the years since 2012, there was a 568 metric ton deficit for those 4 years. And I think 2013 was the highest. It was 229 metric tons. Well, Kenneth, that comes out to be 18.3 million ounce deficit. Now, these stocks came from somewhere. Where they came from, we're not sure. But that I attribute that 18.3 million to give you a reference point. That's all the U.S. Mint Gold Eagle sales since 1988. All of them. And so it just goes to show you gold from the United States, Americans aren't interested, except a very few percentage are. Gold continues. And matter of fact, I got one more chart in that article. If you forget the consumption and scrap, we exported every single bit of our mine supply and our imports, which were 478 tons last year, and our exports were 478. So we exported everything that we mined, and everything we imported was just exported right to most of it went to China, Hong Kong, Switzerland, the UK, and India. That's where most of it went. And so we continue to see this, Kenneth. The U.S., Australia, and even Canada continue to ship gold to the east. If not the east, it goes to Switzerland or the UK, and then that heads to China or India or Asian countries.
Steve, do you think central banks are losing control of the price of precious metals and also the markets overall, being able to hold everything together here in 2016?
I think so. Of course, people are going to say, well, the central banks are going to continue. They're manipulating the price up and then manipulating the price down. Well, we just had the new ABX fully allocated exchange just start, and that was actually on Wednesday. So it's kind of coincidence that Thursday the prices really went haywire. Actually, this ABX is a fully allocated exchange for gold and silver, and I think in time it's going to put a lot more pressure on the Fed and central banks. That being said, I do feel investors and even mainstream investors are seeing what's happening in Deutsche Bank and watching these banks now. The bank stocks have been selling off. They've kind of gone up a little bit lately, but I do think 2016 could be the year that if we see Deutsche Bank go under, it will make Lehman Brothers look like a walk in a park, because Lehman Brothers was more U.S.-centric mortgage-backed security, whereas Deutsche Bank is one of the largest derivatives holders in the world, and they are more global. I mean, they've got a lot of debt money invested into a lot of the Glencores and the commodity and energy industry, and we're seeing that really crumble. So I think the central bank using their member banks like Deutsche Bank and Barclays and J.P. Morgan and Goldman Sachs, I see that this year they'll come under a lot more stress. And at some point in time, we're going to see a physical run on the metals, and I don't think the central banks will be able to paper it over with market rigging.
Yeah, it's really that transfer of wealth that a lot of the truth seekers and the alternative media has been talking about, from the financial assets to real assets, and I think we're starting to see that here. So I agree with you very strongly on all of that, Steve. So, Steve, let's transfer over and transition into energy. I want to get an update on energy and what's going on, starting with shale oil companies and the production of oil here in the U.S. with sub-$30 oil.
It's a disaster. That's basically it's becoming a disaster, and I think the prices of oil, especially U.S. West Texas, will continue to decline. And the reason for that is, and my education, it becomes larger, or let's say more expanded. The more I look into these things, the more I find out. And one of the newer things I found out was that from the U.S. build, the biggest build of inventories takes place between January and April. That's when we see the largest builds. And then what happens is in March and then beginning of April, we start seeing the refiners, they do maintenance, and then they switch over to a summer blend. And so right now, Cushing, Oklahoma, which is one of the larger, let's say stockpiles where we where we store oil, it's at 85%, and normal is 50. We're at 85%, and it's the middle of February, so we still have actually 2.5 more months of premier building in the U.S. And some analysts thought we would see in the last quarter of 2015, we would see U.S. and world production start to decline a little bit and demand pick up. Well, it did the exact opposite. Iran brought more oil production on. And so what's happened is oil production, U.S. and globally, is still elevated, and demand continues to fall. So we had even a larger surplus in the fourth quarter 2015, and I see this continuing for at least the first half of the year this year. So I think, Kenneth, we could see sub-20 oil, and it could happen very quickly. I think we could be in the teens. Now, what is that doing to the shale oil companies? Well, there's two things going on. One, it's totally gutting their financial balance sheets. They can't really make money, even though there's a lot of this talk or articles that they're lowering costs. That's all bogus. They're not lowering costs. They're not being more efficient. And so what's happened is the banks that have all this debt, energy debt, are in trouble, and these energy companies now are in trouble. But there's a second issue going forward, especially in the United States, and this article just came out today. The Sierra Club is now suing Devon Energy, Chesapeake, and Dominion because of what is known as increased earthquake activity due to deep water injection of waste from oil production and gas production.
Oh, wow.
Now, what is interesting, Oklahoma had an average about 160 earthquakes a year from 1977 to 2009, average. And these were small, but they had about 160 earthquakes.
Right.
In 2015, they had 5,800.
Wow.
And so now we're seeing more problems, and I think there isn't huge damage like towns that are totally devastated and homes collapsed, but what there's a lot of damage that is minimal, but there's a lot of it. There's cracks in infrastructure. There's leaking pipes now. Homes may not fall apart, but they're settling, and so there's a lot of damage. So there's a lot of very upset people in Oklahoma and Texas, Kansas, and now I hear we're starting to see earthquake activity pick up in Pennsylvania, and that's where the Marcellus is, which is one of the biggest shale gas producers in the United States. So I think going forward, 2016, we're going to see major bankruptcies in shale oil industries. And what's interesting, Kenneth, and I'll conclude here, the big three U.S. oil companies are actually ConocoPhillips and Chevron Texaco. They're having negative free cash flow. They're going to have to cut their dividends because they're not making enough cash to pay for the capital expenditures and their dividends.
Yeah, these are majors, not shale oil companies dependent on shale oil, right? I mean, these are the majors.
No. The majors are, you see, I talked with a gentleman who is he's in Texas. He's a president of his own small oil company, and I have conversations with him about this problem with earthquake activity and deep water injection. And he tells me he goes after conventional oil, which is let's say vertical wells, not horizontal fracking, and those kind of wells make good profits, and they help the community. They pay good taxes. They're not destructive. He won't look for oil until oil reaches $60-65. We're half there. It's at $30 right now. So that goes to show you, even the conventional oil production isn't really making any money in the United States.
Steve, could you touch on the collapsing production that we're seeing in the U.S., just to give us an idea on that? And I didn't tell you I was going to ask you about this ahead of time, but I know you wrote on January 28th, another nail in the U.S. coffin, and you have all these charts about the oil fields and how they're just falling off a cliff. And maybe you could just conclude with that. Just talk about a little about what's going on with the production from their peaks.
Well, the reason why we're not seeing larger declines in shale gas and shale oil is there has been the rig count has been decimated. And let me just give you an example. And at the peak in 2014 September, the U.S. had like 1,930 oil and gas rigs working. That was the peak. That was before oil prices really started to decline. Mm-hmm. But you know what the number is today? 541.
Oh, wow.
That's a 72% decline in the oil and gas drilling rigs. I mean, 2 weeks ago, it fell 31 rigs in 1 week. Last week, it fell 28 more. Mm. What's happened is oil production in the U.S., which is mostly shale, peaked at about 9.6 million barrels back in about April, maybe early, about the first quarter of 2015. It peaked. Since then, it's fallen about 500,000 barrels a day. Mm. It's about 9.1. So we haven't really seen a collapse yet. But the reason for that is there has still been a lot of wells that were already drilled. They were just waiting to be fracked. And they were continuing to bring on more wells now. But I think with the drilling rig count collapsing, especially over the past 2 quarters, we're going to see almost 1 million barrels taken off, maybe by the end of this year. And that will just get worse if the price of oil continues to remain low. And I don't see the price of oil actually recovering, not for several years, because I think the demand will continue to fall, Kenneth. Even if supply falls from the U.S. and abroad, I see demand falling faster than supply.
You answered my question there. I was going to ask you, and maybe you can follow up on it a bit. with cheap oil and it causing companies to have to go under and production dropping off, wouldn't we see eventually the supply-demand aspect of it work itself out and then see prices rise higher?
Well, I think one of the biggest follies is trying to predict where the price of oil will go. And I do think, of course, there could be price spikes in the future. And that could be a war, a real war taking place in the Middle East where things get totally out of control. Oil production really gets cut off because we have to remember in 1973 and 1979 we had two oil price shocks, and that was due to the Arab oil embargo in 73 and then the Iranian Revolution in 79. I mean, a lot of people don't realize it was worse in 79 than it was in 73 because when the Ayatollah took over Iran, they were producing about 5 million barrels a day. Within a very short period of time, it was almost like 3.2 or 3.3 million barrels were taken off. And the U.S. was heavily reliant on Middle East oil at that point in time. And that also impacted the price of oil significantly in 79 and 80. And it also impacted the price of gold and silver. Now, this time around, there has been so much debt put into the system to bring on this expensive oil. Now that we brought this expensive oil on, like Canadian tar sands, I mean, Alberta is a disaster. I don't know if you've seen reports or articles. It makes North Dakota look like a picnic, and North Dakota is a disaster now because the production will decline. There's no drilling activity. The drilling activity has fallen off a cliff in North Dakota. So I think going forward, Kenneth, it's going to be hard to determine what's going to happen with the price of oil, but I think the huge amount of debt in the system, I don't think we're going to be able to continue to fund or finance oil and gas production. And I got a chart right in front of me, and I'm going to write about this in the future, showing how the CapEx has gone up almost exponentially since the 80s, oil and gas world CapEx. And in 2014, the world spent a little more than $700 billion in CapEx for oil and gas. Do you know in 2015 it fell 20%?
Wow.
And then this year it's going to fall another 15, but it could be even more. This is actually the first time in history we've had 2 years of world CapEx reductions. It's never happened before. It happened a little bit in 86. There was a little drop-off in 99, and there was a little drop-off in 2009. We're talking little. We're talking maybe a 5% drop-off in CapEx. We had a 20% last year, and now we're going to have another 15, I think another 20%. Wow. This is totally gutting the U.S. and world oil and gas industries. And even if we do see higher prices, I think the debt now is so tremendous in the system, as well as the energy companies. I don't think we're going to see a lot more CapEx expenditures. Wow. Because you know why? We need 110, 120 oil to bring. Let me just end by saying this. Back in the end of 2013, the major oil companies realized they weren't going to get 120. They were getting 100, 105, 110. They needed 120 to bring on more oil. And so they realized the market wasn't going to pay 120 because over the last 3 years it only was paying about 105 or 110. So they started cutting at the end of 2013 on these bigger projects. Well, the world actually needs to have oil prices like 110 to 120, and I don't see that. We may get to 50 or 60 or a price spike to 80, but I don't think the world will see above 50 on average for quite a while. And so we're going to see a collapse of U.S. and world oil production going forward.
Yeah, it's the perfect storm for sure, to say the least. So, Steve, I'll let you go here. I want to thank you again for coming on the show and giving us an update on precious metals and energy. You always bring so much to the table. Is there anything else that you wanted to share before we hung up the phone here?
No, just if your readers would like to come to my website, the SRS Rocker Report, I put out 2 to 3 articles a week on energy and the precious metals. I don't get, unfortunately, precious metal investors are fickle, and they're kind of focused just on precious metals, and they should really understand energy, because the energy is the key to the value of the precious metals going forward, and as well as the assets or the value of most assets going forward too will be determined on the energy situation. And so I will be writing more reports and more articles about how this is going to unfold. And I do think there's this famous Roman philosopher called Seneca, Lucius Seneca, and basically he said, the increase of growth is slow and sluggish, but the way to ruin is rapid. And so we have seen oil production move up in a bell-shaped curve. We have seen growth, GDP growth, and all that move up in a bell-shaped curve. But I think what happens, it's not going to come down in a bell-shaped curve. We won't see a slow decline. We will see a sharp decline, a Seneca cliff. And I believe that is what we're going to see. And I think we are in the beginning stages of that. So investors need to be prepared to be in precious metals and to be out of the system, the highly leveraged, debt-based fiat monetary system. They still have time, but I think as time goes on, there's going to be a lot less time for them to be prepared for what is going to come.
That's important advice, everyone. And I just want to remind everyone that Steve puts out some of the best research out there on the internet when it comes to, all the things that we were talking about. So if you do want to support Steve, go to his website and you can donate and support the work that he does. He puts out amazing stuff. So Steve, thanks so much for coming on the show with me today.
Always a pleasure, Kenneth. You have a good day, and we'll talk again in a few months to see what changes have taken place.
Absolutely.